Well, joining us now to share his commentary on the day's market performance is Jason Horn from Steyn Capital Management. Hi, Jason. Good to chat to you. And It's been a very volatile day, hasn't it?
It has indeed. I think kind of speaks to the nature of how fragile equity markets, broadly speaking, in the developed world have become. I mean, we've seen an incredibly concentrated rally since April, centering around tech, and it looks like a few comments from some of the larger investment bank CEOs speaking to how stretched valuations are has led to a bit of a sell-off. So we're definitely seeing a bit of risk-off sentiment across the board, very, very much reflected in the currencies, as well as US bond yields. So it does seem like a lot of investors are, to your point earlier, probably booking some profits from that run. But at the same time, then looks like there's a bit of movement into the dollar and US treasuries as well.
Yeah. Interesting with Optasia, they're listing down about 4% the last time I looked, but it is the first day.
Agreed, yes. Look, I mean, it was the incredibly popular IPO, multiple times oversubscribed at $19. So what you're seeing now is, I think VWAP last time I checked was about 19.5. So look, liquidity is not great at the moment, but you will see a lot of the active players essentially flipping their positions as well today to book some profits from this. But yeah, I guess the jury's out in terms of inclusions in various indexes, and then we'll probably see some passive flow into the name. So yeah, very, very good day for the guys at Optasia. But yeah, it looks like on a relative basis, pretty strong trade versus the rest of the market.
Yeah, and then there's Pepkor as well. You heard now with their new acquisitions, they've been shopping. What's this doing to their share price?
Yeah, so I think Pepkor in line with the rest of the market down today. I think at the margin, probably, yes, this is a good deal for them now that it's finally wrapped up. I think it represents just shy of 2% of the company's market cap, but at the same time, I mean, this is just another growth lever to enhance their top line going into FY26.
Yeah, you can see it there. You can see the up and down of it. Something else as well. I mean, Starbucks to sell their majority stake in their China business. I find that interesting because Starbucks, they've been battling a little bit over the past year or two, ever since after COVID, and now there's this.
Yeah, absolutely. You've hit the nail on the head there. I think, like with a lot of US businesses in China, it has been a bit of a struggle in recent years. And the reality is they are losing ground to local rivals. I mean, yes, there is the argument around nationalism and reluctance to pay these premiums for foreign brands. But the reality is, in China, there's been this big amount of pressure on the consumer, given how weak property is and how locals are so invested in the property market. But I mean, China's local coffee producers, I mean, the biggest rivals to Starbucks are selling effectively the same product at about a third of the price. So while we've seen Starbucks concentrate menus and stuff in the likes of the US, they've been pulling on all these various levers over the last year or so to try and cater to more of a local flavor, but been unsuccessful. So at this point, I think they've said, look, we want to grow from about 8,000 stores to 20,000 stores in China, and the best way for them to achieve that, it seems, bringing on local partners to help them with that rollout and hopefully generate the growth that they're looking for to reach those targets in the medium term.
You know, Jason, it's very interesting. Does this have anything to do with being anti-Trump, anti-United States? Because as much as you want to buy into that market, at the moment, these two countries are not friends.
No, that is true. I think at the same time, you are seeing a lot of deal making going on in Asia this past week. So from a US-China perspective, yes, it's probably Difficult because it's a more volatile relationship that we've seen over the last year or so. But having said that, I mean, the relationship with China hasn't been particularly good since 2016. I think there was a doubling down of the Biden administration in terms of rhetoric towards China. And yes, that has not been helpful for US businesses. But at the same time, yeah, Starbucks in China is viewed as a luxury product, and I guess just anecdotally, if one comes under pressure financially, and I can save say 70% on a cup of coffee, I'll probably get the cheaper cup of coffee.
I love it. I love it. Right, Bank of America. This is good news, saying S&P Global may look quite favorably when it comes to ratings. That's great news.
Yes, it is. I think if we look at the data that's coming out of Treasury and SARS and the like, I think we're seeing incrementally good news around South Africa. I think from a politics point of view, largely speaking, no news is good news. So it seems like that the GNU relationship is continuing, which is great. I think performance overall in the likes of Transnet is picking up. And I think if we look at Transnet specifically and the reforms going on there, we're probably in for a real growth surprise. And the investment banks are picking up on this. I mean, if we look at also tax collections for the first half of the year, this doesn't include the material bump in precious metal prices. So the second half of the year will probably be better. And it looks like from a revenue perspective for the government overall, we are going to go beyond what has been budgeted for. So the primary surplus that National Treasury is looking for, which is so critical to financial stability going forward, is probably going to be even better. I mean, things will become a lot clearer when the midterm budget policy statement comes out in next week. But it looks like incrementally we're having all these small wins. So we've got reforms, we've got fiscal stability, and along with growth, a lower interest rate environment, as well as these tailwinds that a weaker dollar, as well as a lower interest rate environment globally does provide to emerging markets, and has trickled down to South Africa. It looks like South Africa is slowly but surely coming out of the doldrums, and it looks like the outlook for the next 6 to 12 months is a lot better than it was 12 months ago.
Sure. Well, that's good. May it continue. Now, before we move to your stock pick, let's take a moment to touch on which counters your industry peers are watching closely.
Incredibly cheap in its universe, and where some of the other SA Inc. stocks have been penalized for venturing into the rest of the subcontinent and overseas, Nedbank seems to be punished for withdrawing from the rest of the continent and being a purely SA-focused business. Jokes aside, the last set of results were a little bit disappointing. But I pick it not only as a value call in of itself. It's on a PE of 6 and a dividend yield of 9%. That just absolutely screams value. It also comes back to that argument around the repricing of the bonds. The banks have been historically correlated to the yields on the bonds, and they are frankly, all of them are looking very, very reasonable at the moment. Nedbank just looks like the cheapest of the bunch, and overall we quite bullish on both the credit cycle and perhaps even upgrades in the expectation for South African growth.
You're buying a business that's 6,000 stores, 2 in 3 of every baby clothing item in South Africa sold by them. Wow. 1 in 2 of every kid's apparel is sold by them, and 7.5 out of 10 of every prepaid cellular handset is sold by them. So you're buying what I would characterize as a platform business. And you've got to say, well, when you buy a company and you're looking at the future, which is uncertain, how many ways can they win? And this company, they can win in apparel, they can win in cellular, they can win in financial services, they could win in furniture, they could win online, they could win with Avenida in Brazil. There's a lot of stuff that can go right, and Peter Erasmus is well incentivized personally to make sure that things do go right. So competent management, strong model, everyone's incentivized in the right way. I think it's a decent story.
Right, 2 strong ones there. Now, Jason, time for your stock pick. But first, what about Nedbank? We spoke about Pepkor, but Nedbank's the other one.
Yeah, so from a 12-month forward PE perspective, it's trading at near historic lows, and I think for all the reasons to be positive and bullish on South Africa and South Africa Inc. in particular, Nedbank, like most other banks, will likely be a beneficiary of this growth surprise that I've been talking about. So, couple that with a good dividend yield, crazy low valuation, it does look extremely attractive.
Yeah, right. What's your stock pick? Those are those two. What's yours?
Mine is South Africa Inc. in general. I mean, the JSE, as we all know, has had a really good year so far, but this has been primarily driven by the precious metals cohort, where, to be quite frank, SA Inc. has gone nowhere. And then you have South African bonds, on the other hand, that have actually done really well. So you have this allocation to SA bonds, but this hasn't quite filtered down into SA Inc. equities. So, yeah, and up until recently, these names in general have been used as a funding trade for the golds. And last month, when we saw the wobble in the gold price, we did see this trade unwind somewhat, and with the SA Inc. names outperforming. So I guess, yeah, with the EM rally that we're seeing globally, ongoing reforms in South Africa, better outlook, removal from the grey listing, it does feel like with valuations in SA Inc. at these levels, you can almost close your eyes and pick one or two, and over the next 18 months, you're going to do quite well.
Love it. Jason, thank you so much. SA Inc. it is. Do appreciate you taking the time, really do. That was Jason Horn from Steyn Capital Management.